So you've invested in a company, and now it's liquidating. What happens with that final payout you get? Is it completely tax-free? Well, that's a huge question for any shareholder. And the answer is all tucked away in Section 68 of the new Income Tax Act 2025. In this explainer, we are going to unpack exactly what you need to know.
All right, here's how we're going to break it all down. We'll start with a quick intro to company liquidation. Then we'll get right into the nitty-gritty of Section 68 itself. After that, and this is the important part, we'll walk through a real calculation so you can see how it works. We'll also touch on some really crucial compliance issues, and then we'll wrap it all up with the key takeaways. So let's jump right back to that core question. A company is shutting down, you're a shareholder, and you get a payout. Is that money tax-free? It's the first thing everyone asks. The short answer? Nope, it's not. Section 68 is the specific rule that tells us exactly how it gets taxed, and that's what we're here to figure out. Okay, to really get a handle on the tax side of things, we've got to look at this whole liquidation thing from two different angles, right? There's the company's perspective, the one that's closing its doors, and then there's the shareholder's perspective, that's you, receiving the assets. And believe me, the law treats these two very, very differently.
First up, let's look at it from the company's point of view. Now, under Section 68, when a company hands out its final assets to shareholders, the law says this is not considered a transfer. And that's a really key detail because it means the company itself doesn't have to pay any capital gains tax on this distribution. For the company, it's pretty much a tax-neutral event.
But, and this is the absolute crux of the matter for us today, the story completely flips when we look at you, the shareholder. The second you receive that money or any other asset from the liquidating company, bam, the Income Tax Act says that's a taxable event. And this right here is what Section 68 is all about.
So, if it is a taxable event for the shareholder, what's the actual legal basis for it? I mean, where is this written down? Well, that brings us straight to the legal framework itself, specifically Section 68 of the Income Tax Act 2025. Now, for all the seasoned professionals watching, this is going to look pretty familiar. The new Section 68.2 basically just carries forward the exact same core idea from the old Section 46.2. The fundamental rule hasn't changed a bit. Whatever a shareholder gets during liquidation is going to be taxed under the head capital gains. This kind of continuity is super important because it provides consistency and predictability in our tax system.
Okay, before we can even think about calculating the capital gain, we absolutely have to get our heads around this concept of a deemed dividend. So, what is it? Section 240C of the new Act lays it out. Any payout during liquidation is treated as a dividend, but, and this is a big but, only up to the amount of the company's accumulated profits. This is the very first and honestly the most important deduction we're going to make in our calculation.
All right, enough theory, right? Let's see how all of this actually works in the real world. We're going to walk through a super clear, step-by-step example to figure out the actual capital gains liability for a shareholder.
Okay, let's break this table down step by step. First, in Step A, our shareholder gets assets valued at 10 lakh rupees. Simple enough. Now, for Step B, we find out the company had 2 lakhs in accumulated profits. This specific amount gets treated as a deemed dividend, so we subtract it. That brings us to Step C, 8 lakh rupees. And this is what Section 68 calls the full value of consideration. Finally, from that 8 lakh, we subtract the shareholder's original investment, what they paid for the shares, which is 1.5 lakhs in Step D. And there you have it. The result in Step E, 6.5 lakhs, is the final taxable capital gain. So just to really hammer this home, the most important term to pull out of that calculation is full value of consideration. It's not the total pile of cash or assets you get, no. It's the value after you've taken out that deemed dividend. This is the magic number the tax department is going to use as your sale price when they calculate your final capital gain.
Okay, so knowing the law is one thing, but actually complying with it, that's a whole other ballgame. Let's switch gears a bit and talk about the procedural side of things, the duties and the common pitfalls that professionals really need to watch out for during a liquidation.
It's not just about the shareholder's tax, There are also some really strict duties for the liquidator, all spelled out in Section 222. First off, within 30 days of being appointed, they have to give a notice to the assessing officer. The AO then gets 3 months to figure out the company's estimated tax bill. And listen, this next part is an absolute must-do. The liquidator has to set that tax money aside before giving a single rupee to the shareholders. If they mess this up, they can be held personally responsible for the company's tax. That's a huge deal.
So, these rules naturally lead to a few common mistakes that we see all the time. The most frequent ones? Getting the valuation of the assets wrong. Miscalculating the accumulated profits, which, as you saw, throws off the entire calculation. Then there's the liquidator just plain missing those tight Section 322 deadlines. And probably the most basic mistake of all, just forgetting to subtract the deemed dividend before calculating the capital gain. It happens.
Whew, we've covered a lot of ground here. So let's take a moment and just boil it all down to the most critical takeaways from this explainer on Section 68.
All right, so to wrap it all up, number 1, for the company, liquidation is tax neutral. For you, the shareholder, it's definitely a taxable event. 2, that tax is calculated as a capital gain. 3, and this is the big one, you have to deduct the deemed dividend first to find your full value of consideration. 4, the liquidator has some very specific time-bound duties under Section 322 they cannot ignore. And finally, number 5, if you're used to the old law, don't worry, Section 68 keeps the same core principles as the old Section 46. Got it? Good.
And that's our deep dive into Section 68. Thanks so much for watching. If you found this explainer useful, we'd really appreciate it if you'd like, subscribe, and share it with anyone else who might need it.
Just a quick reminder, this video is for educational purposes only and is not professional advice. Tax laws can and do change, so please be sure to consult your professional advisor before taking any action. This is an AI-generated educational video.